Hello Grand Levens, welcome back. I'm pretty sure you guys know the drill by now. I'm actually going to do a video on insurance and investment. I'm going to try and, if I look this way, my screen is this way, so I'm not always going to look at the camera, I just need to see what I'm looking at. So I'm going to run through all of investment and all of insurance for you. Okay, so welcome back, and we'll skip that. But just so you guys remember, so clothing retailers is your new topic for the year. So whenever you try and use examples, try and use this as much as possible. Okay, but this is especially prevalent when it gets to the business report. Okay, so what do we want to talk about? We want to talk about here comes the money. Where does investment come from? You want to know is how can you turn those couple of coins into a note, and how do you turn that note into $100 note? So that's what this investment chapter is all about. Okay, so when you invest, you can invest in millions of things: stocks, machinery, land, or property. Okay, you want to make sure that you are investing your surplus funds to actually generate an income. Okay, you will never be a business that merely just invests. It's always your surplus funds, your extra funds that you want to do more with. So we'll look at each and every one of them. So the first thing is a share. So when a company registers and it registers its capital, it has to register shares, and it has to be listed on the JSE. If you own a share, you own a portion of the company, and always there's returns that come along with it, and also risks that go along with it. Okay, so we're always going to look at three things: risk, return, and time period. So we'll look at it for all of them, so I'm going to run through them quick. Okay, why is it easy? It's a very easy way to create wealth, easy to create, and you can go through a stockbroker. You can buy shares, anyone can buy shares. Big company, small company, medium company, anyone can. But there's always a disadvantage that share prices rise and fall. As I said to you in class, it depends on how many people want your shares. The more people want your shares, the more those shares are valued. So you've got to make sure that when you buy a share, that it's a company that's not going to be liquidated. Remember, we spoke about liquidation, and you need to pay out in that regard. The other risk you run is that they won't pay out dividends. And how you can negate this risk is you can go and you can buy preference shares. These ones will always get dividends, but the highest risk that you run is that this company fails and the share price falls. Okay, so that's the risk, is that volatility, economic conditions, industry trends, things that are outside of your control affect how well this business is going to operate. And especially when you're listed on the JSE, supply and demand makes it go up and down crazy. Okay, so you diversify your portfolio. You go into different industries, different geographical areas. You look to see that when one is gaining, the other one is losing. And you generally do that in the long run. Remember, I showed you with the graph. In the long run, even though it's volatile, you normally still see a positive growth trend. So if you want to make money, short-term trading is really good. If you want to make sustainable growth, long-term trading. Okay, and you do it by looking at a fundamental analysis. You go and look, what company has a competitive advantage? What one has a strong financial sector? And a stop loss order is also possible. You say that if the share goes below $50, sell it. So you limit the amount that you are willing to lose by doing a stop loss order. Okay, these are all risk management. You can also say, do a very good analysis of the business books. Choose Fortune 500s or blue chip companies, which are of the top 500 in the world, and they are relatively safe investments. Okay, there are two ROIs. The first is capital gains. Capital gains is when you hold onto something and you sell it at a higher price later. And then obviously we said dividends. Dividends is that percentage or a couple of cents per share that they hand out at the end of the year. So you need to look at what are your conditions, what are your markets, and decide from there how are you going to approach them. Okay. So timelines is you can go short-term trading. That's when you want to take advantage of volatility. When you see something's dipped and you want to take advantage because you know it's going to rise again in the short term. But if you want to take the long-term investment and you know a company's got a competitive advantage like Tesla did, you go long-term. Okay, now we've got debentures. And debentures are more like a loan for a business. So a business hands out a debenture and you give the business money. And after the debenture matures, which remember, an investment matures, it doesn't end, it matures. They give you your thing back, and they give you interest payments up until that period. Okay, so they are unlike shares, which have dividends. They offer interest, but a lot of them are unsecured. So if the business fails, you do lose that debenture is not worth anything, and the business doesn't pay you back first. Okay, but you also earn a fixed interest rate. So unlike shares, you know you're going to get money out of them. Okay, and it has to be lower than shares. Why? Because it's guaranteed. Whenever something is guaranteed, it is always lower than something that is not guaranteed but has a higher growth potential. So it's suitable for those who want a regular income rather than a higher capital appreciation. Okay, they normally have a predetermined lifespan, normally about 5 years, but longer term ones do exist. Time period is one that you can actually just read through, but don't spend too much time on it. Here are 3. So, redeemable ones are ones that you can redeem or have repaid before they reach maturity. Convertible ones can be converted into shares, and secured ones have some form of collateral. So, if I ever ask you, how do you mitigate the risk of a debenture? You say we want one that's secured, or even convertible or redeemable. Any one of these 3 can be used to negate the risk. Okay, so we've already spoken about this. Okay, both of these, so yeah, again, they both are financial things. However, in ownership, shares give you partial ownerships, debentures do not. Shares have a return of dividends, which are volatile. They could be very high, but they also could be very low, whereas debentures have a fixed payment of interest, but they are guaranteed. Okay, and the risk and priorities. Debentures are lower risk, but they're also lower reward. Shares are higher risk because they could be up and down and volatile. But with a debenture, you know you're going to get that money back in 5 years, and you're going to get the fixed interest. Only debentures can be converted into shares. You cannot convert a share into a debenture, unfortunately. Don't worry about endowments. I promise you I will not ask you about endowments this year. We will look at endowments next year. Unit trusts. Okay, so unit trust is where multiple investors pool their money and they appoint a unit trust manager or a fund manager, and this guy decides to invest their money elsewhere. Remember I told you about baffled buck? If you have no idea what you're doing, put your money in a unit trust and someone else will take care of all the decision making. Okay. So, depending on what, obviously, so you have some stock-based unit trusts where they look at shares, other ones are fixed income ones, so you have to decide how much risk are you willing to take, and that's what a unit trust manager will have to decide before he takes everyone's money. Okay, it all depends on the underlying assets, the equity, the periods of volatility. If they want modest but stable returns, do they want high returns, and that's how they're going to decide on their return on investment. Okay, it's again suitable for both and long, but you have to normally lock it in for a certain amount of time. Whether that's a long or a short period is completely up to you. Offshore investments. Offshore investments is obviously when you go offshore into stocks, into bonds, into real estate. You can offshore invest in anything. Okay, there's obviously advantages and disadvantages. So I'll have a look at this. You've got to look at things like there's tax efficiency. Some countries are very nicely adept at being at tax. They have a lot less tax. You can hold money if you have instability in your own country. You hold it elsewhere, and it'll be safer. You have international expertise, and it's a centralized and regulated market, so it's a lot safer normally. But you've also got to look at tax efficiency, you've got to look at costs, so some might charge a fee. And always remember that policymakers never want you to invest your money outside of the country. So South Africa might make it a little bit more difficult for you to go outside of South Africa. Okay, and they can higher risks such as if you have instability in that country. So if you want to go high risk, you go and you invest in a country that's growing. Ethiopia, I think, is quite good. Maybe Egypt a couple of years ago would have been a viable option. Okay, Iraq, even Syria, those ones will eventually grow, but they're obviously higher risk. So, depending on the geopolitical conditions, you will see what the risk is. Okay, but they also have different growth rates. As I said, high risk must mean high reward. So Singapore was very little, and now they're one of the biggest growing, but you needed to have invested when they were worth nothing. Okay, whereas if you invest in Singapore now, it's a pretty safe bet, but you can't expect to gain gold from your little bit of silver. Okay, and timeline again, we're not worried about. Collectibles. We spoke about collectibles. You get Krugerrands, you get coins, you get toy cars, and the thing with collectibles is that they reduce the liquidity. Why? Because you have to hold on to liquidities for a very, very long time, to collectibles for a very long time, until the demand for them shifts. If you want to buy a 1980s car, or 80s car, if you wanted to hold it as a collectible, you couldn't sell it in 1990, you had to wait till now to sell it. So, you don't know what the long-term value is either. That could be a hunk of junk in 30 years, it could be a hunk of gold. So, you've got to take the risk with it. So, you've got to be able to predict what is going to be valuable, but it's also very subjective. A Michael Jordan jersey in South Africa is worth nothing. A Michael Jordan jersey in America is worth a lot. So, you need someone who knows the knowledge and has the research. Go and look at Pawn Stars, for example. KPAWN Stars. So that they have collectibles, and you never know what those are going to be worth. Okay, then you get notice deposit. So the next three are notice deposit, call account, fixed deposit, and notice deposit is you put your money in, you get a higher interest rate than in regular savings, but you have to give notice if you want to take that money out. Normally 30 days, sometimes less. I have a 24-hour notice account, so you can decide. Okay, and they are generally low risk investment because they're in a financial institution, and even though they're higher than regular savings, they're lower than most other options because they're very low risk, and you have to normally lock them in for a period. But if you do want them, you can get them out again. Okay, call accounts are almost like it, but you can get that money as soon as you want it, you can get it out as quickly as you want. And obviously that it's moderate returns. Why? Because it's low risk and you still have access to that money. So the bank likes to have your money as fast as possible, and that is why fixed deposits, they will offer the highest return on, because they know that you are going to be leaving their money there and they don't have to worry about you taking that money out again. So you receive the most interest, and you also know that you're low risk. So we ever ask you what are the lowest risk options, it's these three. They're low risk because banks are relatively safe. The paw really has to hit the fan before a bank goes under. So if you ever want to know this, these three are the lowest risk you could possibly get. I would not stress too much about money market, it's just short-term place where short-term equity is sold. So it's only a few days to a year. It's lower risk because you can't expect to make money in 3 days. Okay. So fixed property is tangible assets, things like cars, things like ownerships, things like in that regard. So remember, fixed property, you can make money two ways. Capital gains again, and you rent it out. But the risk is obviously that based on location, so if it's a bad location, it's going to have expenses for maintenance, and your tenants could even damage the property, and then you lose value in that property. So you have to know how to negate those risks. You have to choose a good area, you have to choose good tenants. So, but as I said, you can get it, you can do the capital gains, buy it and then resell it at a later price, or you can do rental markets for this one. Okay. And it's got to be long term. You can't hold onto a house and sell it in 3 months. Physically impossible to do so. Okay. Awesome. So that's halfway done. That is just, as I say, guys, please don't. I know I'm talking quickly, but I also don't want to give you a 50-minute video of me talking. But make sure you go through the whole video. So insurance versus assurance, or short-term versus long-term. In case something happens, insurance is short-term and normally covers a specific thing like a flood or whatever. Assurance is something that you're definitely going to need, as sure as you are that you're going to die. So it's regarding a future event. Okay. So what is uninsurable? War is uninsurable, political unrest is. You cannot change against price changes. You can't say, oh, because the price changed that I'm going to insure myself. You also can't do it because a product ran out of fashion. Okay, you have to also, if a product becomes obsolete, if you say that a product was in fashion now it's not, you can't insure against that, and you can't insure under any lawful actions. Okay, certain natural disasters are, but most of them can be covered. So, indemnity is means for exemption from liability for damage. You passing on the liability that you have to someone else. That's what an indemnity claim is you freeing yourself from any liability. So this gives you security, it gives you peace of mind, so you will be alright. Okay, if you are overinsured, it means that you've insured it for more than the thing is actually worth. If you do that, the risk is that you're going to have high premiums. Your premiums are going to be through the roof because you're insuring for more than you should be. But if you underinsure, remember they only pay out the percentage that you were insured for. So if you only insured 80% of it, you're only going to get 80% of your claim. So both are non-desirable, but overinsurance is probably the better of the two. Okay, why do you do it? Because you're afraid of being underinsured, and also people neglect depreciation. For the love of all that's holy, please remember depreciation. It is important that you look at it every year because you see what has changed, you see how depreciation has affected you, and so that how does it replacing, how is that going to affect you? Okay, how can you avoid it? You have to be proactive. You have to study the terms and conditions of your policy, review your thing annually, and purchase the right cover at the right price. And know what your thing is worth. Don't always get opinions of experts, not just your own. Oh, I know what my house is worth. People don't know what their house is worth. Okay, excess. So excess is a percentage of a claim that you have to pay. It is one way, along with rewards, like an out bonus, that they ensure that you don't claim for everything. By having you pay an excess, some people will say, oh, no, I'm not going to do that because it's more issue than it's worth. And always the reward out bonus is, for example, if you are claim free for 10 years, you get a portion of your claims back. Okay, this one I'm pretty sure is proximate cause. You guys know by now what was the initial cause of the accident, and that is what's going to be considered when you get to a claim. So we said, for example, if an earthquake caused a fire, then you will be covered if you had natural disaster claim, but not if you had fire claim. Same with if you had a heart attack while driving. If they could prove, then your medical insurance has to pay out, but not your accidental cover. So what was the first thing that caused the problem? Okay, subrogation is the legal right to pursue a third party. So as I said, if you and someone else get into a crash, your insurance has to pay it. But if you were found to not be at fault, someone else made a mistake and cut in front of you, your insurance has the right to subrogation to go after the insurance of the other party. So you can go after and get your claim back. Don't worry too much about the policy, but you have to have absolute good faith. And the utmost good faith requires that you disclose all information that is relevant to your contract. You cannot be found withholding information or lying about information. Okay, you have to have insurable interest. You have to show that you have something to lose from it. You have something to lose if you have a fire. Okay, you cannot insure your neighbor's garage. Why? Because it's not your garage. Okay. You have to be contractual capacity, so you have to be at least 18 years old in South Africa. Okay, now we get to our compulsory. The first one is UIF. This helps you look after you if you become unemployed or you have maternity leave, adoption leave, commission, or parental leave. So if you have a long-term illness as well. In COVID, a lot of people were able to live off of UIF, and parental leave was instated, which was not always a part of UIF. They would cover you if you did not get as part of your contract. You could take parental leave and have UIF pay a portion of your salary for that period. So you take one, and what is important is how is it contributed. So it's 1% from both your salary and your employer that gets paid to SARS, and that goes off every month, but you have to have a certain number of criteria. You have to work at least 24 hours a week. You cannot be a commissioner, and you cannot work for governments at any provincial or national level. Okay, but there are some new additions that do it. Foreign workers, people from Zimbabwe, Malawi, Botswana, Angola, are now allowed to have UIF, as well as domestic workers, which was not always the case. Okay, but you've had to contribute at least 4 years. You have a maximum claim period of 1 year, and if you're sick for more than 7 days at once, you are allowed to claim it back as well. Okay, compensation for work-related injuries. This is if you were hurt on the job. While doing your job, you were hurt, and they can claim back if you are injured or lose your life. Instead of UIF, which is 1% taken off of your salary, this is paid yearly off off your income. Okay, and it can reduce risk by ensuring a clean and safe productive work environment. You have to report the injury versus ASAP. You must submit the documents within 7 days, and you cannot, if you're an army or a house worker, you cannot claim because they have their own, and it's only valid for 12 months after your injury. Okay, and the last compulsory one is the road accident funds. This will cover any injury or death due to accidents and offers indemnity to guilty party except under criminal circumstances. And they obviously get their money from your petrol levy or from your toll fees as well. So that's where the road accident fund gets from. And then you have company tax, household tax, vehicle tax, money in transit tax, and fidelity tax, and crop tax. Not infidelity, fidelity, and crop. So company tax is things like against burglary, public liability, which we spoke about, which is when you take out insurance in case someone falls on your premises and then if you weren't careful enough, they can sue you. Your insurance will cover that. If you have partial loss of income, like we said with the gas vein that exploded, you can claim that because people can't reach you, you can claim for partial loss of income. Okay, you need to, if you have content, it means you cover what's inside your business, but you need to keep a record of all your stock levels. And that is what we call the iron safe mechanism. So remember that assets also depreciate, and that depending on the type of building, you might also want to take out fire risk. Household risk is two things. You have dwelling covers, which covers the physical premises against things like, for example, your walls, your roof, your foundation. Content cover, however, looks at what's inside the building. If it gets hurt or if it needs to be repaired, your clothing, your appliances, and that you have to actually tell them what your valuables are worth. Okay, these ones you can always have a read through, so sometimes your excess, what you have to pay to get out, your liability coverage, again, if someone gets hurt in your house, additional living expenses, if you have a leak in your roof and you have to live somewhere else, they'll cover that, and you have some limits that you have to look at. Okay, vehicle coverage. Remember, premiums is what you pay per month. The coverage type is that you get is liability coverage if you hit someone with your car. Collision damage is obviously when you have a collision, and then comprehensive, which looks at theft, vandalism, natural disaster, or any other. Finally, fidelity is when you protect yourself against one of your employees being fraudulent or dishonest, and you make sure that you are covered in case of something happening. But obviously, to be able to do that, you need to be sure that it's only people within your own industry, and you need to prove that you were unaware of their fraudulent activities. You cannot play innocent and say you did not know. If you knew about it and you could have stopped it, they won't pay out for something like this. So you've got to make sure that you are always maintaining, and this is where you can go in and say HR should be maintaining employees, there should be policies in place and culture. And the final, cash in transit is pretty obvious. Cash in transit is when you're moving cash from one place to another. Okay, fire insurance is pretty obvious as well, but remember, something to remember is that you have to look at proximate cause. If the fire was the first cause, you will be covered by fire damage. Okay, and they will have to assess the extent of the damage, and this is also where that thing of iron safe comes in, iron safe clause, where you've got to have a record of what was in your building at the time.